It took 49 days to destroy a government and 48 hours to nearly collapse a pension system. In September 2022, Britain witnessed something that financial textbooks will study for generations. A crisis that didn't come from external shocks, foreign wars, or pandemic shutdowns. It came from within, from a budget announcement that triggered the fastest meltdown in modern British financial history. The pound crashed to near parity with the dollar. Government bonds plunged so fast that pension funds across the country were hours away from insolvency. The Bank of England was forced to intervene with emergency purchases just to keep the financial system from imploding. And at the center of it all was a financial instrument most people had never heard of, one designed to protect retirees but engineered in a way that nearly destroyed them. Welcome to the financial system. Control the money, control the history. And remember, simple is never easy. To understand what happened in Britain, you have to go back decades to the quiet decisions that planted the seeds of this crisis long before any politician took office. The story begins in the early 2000s when regulators across Europe and the UK decided to change how companies accounted for their pension obligations. New accounting standards, FRS 17 and later IAS 19, required corporations to mark their pension deficits on their balance sheets in real time. The intention was transparency. The consequence was volatility. Suddenly, a company's reported profits could swing wildly based on interest rate movements that had nothing to do with its actual business. If bond yields fell, pension liabilities rose, and the company looked weaker, even if nothing fundamental had changed. Corporate boards panicked. They demanded a solution, and the financial industry delivered one: liability-driven investment, or LDI. The concept was elegant. Pension funds would use derivatives, interest rate swaps, and bond repurchase agreements to hedge their exposure to rate changes. If yields moved, the hedge would offset the liability swing. Problem solved. But there was a catch. Government bonds, gilts, offered low returns. To generate enough income to meet future payouts while also hedging liabilities, pension funds needed to stretch their capital, so they used leverage. They borrowed against their gilt holdings to amplify their positions. A fund with £1 billion in assets could control 2, 3, even 4 billion in exposure. As long as markets remained calm and interest rates moved slowly, the system worked beautifully. Pension funds reported stable funding levels. Corporations saw predictable balance sheets. Everyone was happy. But leverage is never free. It works like a multiplier in both directions. Small gains become larger gains, and small losses become catastrophic ones. By mid-2022, British pension funds had accumulated roughly £1.5 trillion in liability-driven investment strategies. Around 60% of all private defined benefit pension schemes were using some form of LDI. The funds were concentrated in long-dated government bonds, the very securities most sensitive to interest rate changes. And many of these positions were held in pooled funds, where hundreds of smaller pension schemes shared the same portfolio. The system had grown so interconnected that a single shock could ripple through the entire retirement infrastructure of the nation. The vulnerability was hidden in plain sight. But as long as rates moved gradually, no one felt the danger. Then came September 2022. Liz Truss had just become Prime Minister. Inflation was running at 10%. Energy prices were crushing households. The Bank of England had already raised interest rates 7 times in less than a year. And into this pressure cooker, Truss and her Chancellor, Kwasi Kwarteng, introduced what they called a growth plan, the largest package of unfunded tax cuts Britain had seen since the 1970s. £45 billion in giveaways with no explanation of how they would be paid for. No independent assessment from the Office for Budget Responsibility. No acknowledgement of the inflationary environment they were walking into. The market reaction was immediate and brutal. On Friday, September 23rd, the day of the announcement, 30-year gilt yields jumped 80 basis points in a single session, one of the largest moves in modern history. Sterling collapsed, falling to its lowest level against the dollar since 1985. Traders didn't just doubt the budget, they doubted the government's basic competence. And when confidence collapses, leverage amplifies the destruction. For pension funds using LDI, the spike in yields meant their derivative positions were suddenly underwater. Counterparties, the banks on the other side of those swaps, demanded more collateral. These margin calls had to be met within hours, not days. The only way to raise cash that quickly was to sell assets, and the most liquid assets these funds held were the same gilts that were already falling. This is where the spiral began. As pension funds sold gilts to meet margin calls, the selling pressure pushed prices lower and yields higher. Higher yields triggered more margin calls. More margin calls forced more sales. The feedback loop accelerated faster than any risk model had anticipated. By September 27th, some pension funds were facing collateral shortfalls so severe that they were hours away from defaulting. If they defaulted, the banks holding their collateral would seize and liquidate those gilts into an already collapsing market. The entire bond market risked going into free fall, and with it, the ability of the British government to borrow, the stability of household mortgages, and the solvency of pension promises made to millions of retirees. On the morning of September 28th, the Bank of England made an emergency announcement. It would buy up to £5 billion of long-dated gilts per day for the next 13 days. The goal wasn't to prop up the bond market permanently. It was to break the feedback loop, to give pension funds time to raise collateral and reduce their leverage before the system imploded. In the bank's own words, without intervention, yields could have spiked to 7 or 8%, and around 90% of UK pension funds would have been wiped out. The intervention worked, barely. Between September 28th and October 14th, the bank purchased £19.3 billion of gilts. Pension funds scrambled to sell other assets, call in capital from sponsors, and deleverage their positions. The immediate crisis passed, but the damage was done. £425 billion were wiped off pension fund asset values over 2022, with the sharpest losses concentrated in the weeks after the mini-budget. Mortgage rates spiked to their highest levels since 2008. The average 2-year fixed rate jumped from 4% to over 6% in a matter of weeks. Lenders pulled nearly 2,000 mortgage products from the market overnight. Households that had locked in low rates suddenly faced the prospect of doubling their monthly payments when their deals expired. Repossession claims surged. Home purchases froze. The housing market, already fragile, seized up. And the political fallout was equally swift. Kwasi Kwarteng was fired on October 14th. Liz Truss resigned 6 days later, becoming the shortest-serving prime minister in British history. The entire ideological project she had championed, tax cuts, deregulation, unfettered markets, collapsed in 49 days. But here's the uncomfortable truth most coverage missed. The mini-budget didn't create the vulnerability, it exposed it. The pension system had been engineered over 2 decades to rely on leverage and low volatility. Regulators had watched the buildup of LDI exposure and done little to stress test for a rapid rate shock. The Financial Policy Committee had flagged concerns years earlier, but systemic reform never came. The accounting rules that pushed corporations toward LDI in the first place were never revisited. Everyone assumed that because rates had been low for so long, they would stay low forever. And when that assumption shattered, the system nearly broke with it. This is the lesson Britain offered the world, for free. Leverage hidden in pension funds is still leverage. Derivatives designed to reduce risk can amplify it when liquidity vanishes. And financial stability built on the assumption that nothing will ever change is not stability at all. It is complacency dressed in sophisticated language. The modern financial system is filled with structures like LDI, instruments that work perfectly in calm conditions and catastrophically in stress. They're designed by people who assume the future will resemble the past. They are sold by institutions that profit from complexity, and they are held by ordinary citizens who have no idea what risks are being taken in their name. So the next time you hear that your pension is safe, that the system is resilient, that experts have everything under control, remember September 2022. Remember how 48 hours nearly erased decades of retirement savings. Remember that the people who built the system never tested it against reality. And remember that in finance, the bill always comes due. The only question is who pays it and whether they even know the debt exists. History doesn't repeat, but if you don't understand it, it will crush you all the same. If this gave you a new perspective, hit subscribe. Its financial system and history leaves clues. I show you where the money leads.